Everyone is concerned about inflation right now. In this video, we'll go through a hierarchy of different investment categories and how they rank during inflation periods, all according to Warren Buffett. Now let's get into the video. Cash is the worst investment to make during a period of inflation. Warren Buffett isn't the only investor who dislikes storing cash during inflation. Fellow billionaire Ray Dalio has also been vocal about his dislike of cash with a highly memorable and rather catchy quote: "Cash is trash." This is because, during periods of inflation, cash sitting in a savings account or your home's drawer gradually becomes less valuable by the day, week, month, and year. One of the most important messages I want you to have from this video is that you, as an investor, need to consider your investment returns in real terms. The math underlying estimating your true return on investment is straightforward. Let's imagine your assets returned 10% every year. That's fantastic, right? Not so fast. It is entirely dependent on the pace of inflation. To assess the true return on your assets, you must deduct the impact of inflation. So, if inflation is 7% and your assets yield 10% that year, your real return is just 3%. Isn't it nearly as exciting? This is why cash is at the bottom of the hierarchy. The return on cash is practically nothing. According to Warren Buffett, if we poured millions of dollars into every family in the United States today, everyone would be happy except those who invested in goods denominated in dollars. It is important to remember that those who possess fixed-rate debt, such as government bonds, suffer losses during times of inflation. People who borrow money in a long-term plan at a fixed rate, on the other hand, benefit from inflation. People who utilize a mortgage to purchase a home are an example of this. I bought a property in December 2020. I was able to secure a 2.8% 30-year fixed-rate mortgage. This indicates that my interest rate will remain the same for the next 30 years. My mortgage payment will likewise be the same for the next 30 years. This is an incredible place to be in during times of inflation. This is because inflation depreciates the value of mortgage debt month after month and year after year. Inflation reduces the purchasing power of each dollar. Thus, I get to pay off my mortgage with depreciated money. This hierarchy is followed by what Buffett refers to as unproductive assets. These include gold, silver, and other precious metals. Now, they aren't bad to buy during an inflation period since, all else being equal, as the price of everything else rises, these products should, in theory, keep up with inflation. However, these non-productive assets are unlikely to boost your purchasing power. Let us hear Warren Buffett explain this.
I would say this about gold. If you took all of the gold in the world, it would roughly make a cube 67 feet on a side. So if you took all the gold in the world, we could have a cube that went down there 67 feet, 67 feet high, and that would be the whole thing. Now, for that same cube of gold, it would be worth at today's market prices about $7 trillion. That's probably about a third of the value of all the stocks in the United States. So you could have a choice of owning a third of all the stocks in the United States, or you could have a choice of owning that little block of gold, which can't do anything but kind of shine there and make you feel like Midas or Croesus or something of the sort. Now, for $7 trillion, there are roughly 1 billion acres of farmland in the United States. They're valued at about $2.5 trillion. It's about half the continental United States is farmland. You could have all of the farmland in the United States, you could have about 7 Exxon Mobils, and you could have $1 trillion of walking around money. And if you offered me the choice of looking at some 67-foot cube of gold and looking at it all day, you know, maybe touching it, and fondling it occasionally, you know, and then saying, you know, do something for me, and it says, I don't do anything, I just stand here and look pretty. And the alternative to that was to have all the farmland in the country, everything, cotton, corn, soybeans, 7 Exxon Mobils, just think of that. Add $1 trillion of walking around money. You know, maybe call me crazy, but I'll take the farmland of the Exxon Mobils.
Let's move on to the next investment category in our inflation hierarchy. These investors now want to do more than merely stay up with inflation. We want investments that can surpass inflation and provide us with a genuine return. This is where Warren Buffett's concept of productive assets comes into play. We all know that Warren Buffett acquired his wealth by purchasing stocks and entire businesses. However, Buffett believes that not all businesses are created equal. The average company's productive assets are next in the inflation hierarchy. Average businesses have a few features, one of which is that they require a lot of new capital, which is just a fancy name for cash, to continue operating. As Buffett stated, however, most businesses would not fare well in real terms during inflation. Their earnings may increase slightly over time, but they are forced to invest more and more money in the firm just to stay in the same place. And you already know that the worst sort of business is one that requires you to always put more money on the table while not providing you with more earnings. So here's a simplified example based on an actual company that should demonstrate the concept. United Rentals is the largest equipment rental company in the world. They have a straightforward business plan. They also purchase equipment that is commonly utilized in construction projects. Things like bulldozers, temporary bathrooms, and heavy-duty trucks fall under this category. United Rentals then lends out the equipment to construction projects for a limited time, generally for the duration of the project. The equipment rented by United Rentals to its clients does not last forever and must be changed every few years or so. For the sake of simplicity, assume that each bulldozer purchased by the company costs $1 million and that during the life of that bulldozer, it may be rented out to consumers and create $1.2 million in revenue for the company. That's a good $200,000 profit. But let's pretend for the sake of argument that inflation is 20%, which means that the next time the company wants to buy another bulldozer to replace the present one, it will have to pay $1.2 million. As you can see, the company is unable to extract any money from the business in the form of earnings. All revenues earned by United Rentals must be reinvested into the business to acquire new equipment to replace the old. Now, hopefully, I don't expect inflation to reach anything near 20%. And, while United Rentals is a fantastic firm, this example highlights the difficulty that capital-intensive enterprises suffer during inflation periods. Before we go on to the next characteristic of businesses to avoid amid inflation, let me tell you a little anecdote. Charlie Munger, Warren Buffett's colleague and buddy, said something that very well sums up what I explained. There are two categories of good businesses. One is the business where the whole reported profit just sits there and surplus cash at the end of the year, and you can take it out of the business, and the business will do just as well without the cash as it would have if it stayed in the business. The second business reports a profit, but there's never any cash. It reminds me of the used construction equipment business of my old friend. And he used to say, in my business, every year you make a profit. And there it is sitting in the yard. And there are an awful lot of businesses like that, where to just keep going to stay in place, there's never any cash. The second type of average business that you should avoid lacks what is known as pricing power. The easiest way to illustrate what I mean by companies that lack price power is to discuss a company that does have pricing power. When I think about pricing power, the first company that comes to mind is Apple. Apple has such loyal customers that many buyers are willing to pay whatever the business demands for its iPhone product. If someone wants a new iPhone, they are not going to buy a competitor's product just because it's cheaper. Contrast this with a company with little to no pricing power, where the customer's primary concern is price. Assume a corporation produces only plain white t-shirts without any design or branding. because someone will simply buy the cheapest white t-shirt they can find. This means that this company has no price power. This t-shirt producer also lacks the option to raise prices above those of its competitors. Since, if the prices are higher than those of its competitors, customers will simply choose to buy the white t-shirts of this company's competitors. This company will struggle in times of inflation. The cost of materials to produce the shirts is rising, as is the cost of paying employees to make the shirts, and the cost of shipping the shirts to buyers. The only thing that isn't rising is the company's ability to charge for shirts. Do you understand why inflation is so difficult for businesses that lack pricing power? Let us now proceed to the next investment category on the hierarchy. Let us refer to these investments as productive assets or outstanding enterprises. Here's another example. Remember the previous example of the company that spent $1 million on a bulldozer. Let's imagine instead that our friend John here utilizes the same $1 million to create a software solution that makes it easier for YouTube creators to generate videos. As in the previous example, suppose John makes $1.2 million in his first year from that product, with a profit of $200,000. Great. But hold on, there's more. Assume there is also 20% inflation in this case, which implies John may charge 20% more for his software this year than last. This indicates that John's sales of $1.2 million last year have increased by 20% owing to inflation. The good thing about this software company is that John does not have to reinvest any more money in it. He already has the software. However, he may need to spend some money updating and maintaining it. It would be only a very small sum. This is the inverse of the previous example's capital-intensive enterprise. This software business of John's is what is known as a capital-light business. Since the amount of cash John will have to keep reinvesting in the business merely to keep the operations and production of the business running is relatively small. This implies that instead of continually reinvesting earnings into the company, as in the previous example of the equipment rental company, John may withdraw his gains from the business. To find a business that does well amid inflation, look for the polar opposite of the poor business that we discussed previously. You want to locate a business that requires little cash. These are businesses that do not need to continually reinvest big quantities of money to expand. These are frequently businesses with very strong brands, companies like Apple, Coca-Cola, and Buffett owns See's Candies. Other types of businesses with modest capital requirements include those that do not rely on holding a large number of physical assets, such as factories or physical goods. Consider Microsoft, Facebook, and other technology-focused companies. Almost any software company fits into this category because, unlike other businesses, once the software is built and the money is spent on producing it, the reinvestment back into the business is low. Pricing power is another important aspect of a corporation to hold during times of inflation. I'll be the first to confess that determining a company's pricing power is more of an art than a science. But here are some factors to consider. One exercise that I believe is beneficial is to imagine how a customer would respond if the business raised its pricing by 10%. There are several potential reactions customers would have. Don't care about the price rise, take my money please. Or there is no way I'm paying that. When prices are rising due to inflation, you want to buy shares in companies that can readily raise their pricing for their goods. You should avoid investing in businesses in commoditized industries that have difficulty raising pricing even in normal times. Investing in yourself is the greatest way to hedge against inflation. If you are the best at what you do, whether it is as an engineer, a lawyer, a dentist, a plumber, or an accountant, you make yourself extremely valuable to others. The advantage of being highly valued in a marketplace economy is that you can charge whatever you want for your services, and your clients will gladly pay for it. If you like this video, Be sure to click the notification bell so you don't miss any of our future uploads. Stay safe, and ciao.